It's that time of the week. We talk to our buddy Zach Abraham, Chief Investment Officer, Bulwark Capitals. We talk about, a little bit of politics, go with all the financial stuff going on. And I said, is who's Trump going to fire because the PPI numbers weren't very good? Who do you think he's going to fire?
Oh man, there's a delay or there's a data collection person somewhere that I'm sure the heads are about to rule.
He already said
Um,
that those are fake numbers.
yeah, I I will agree with him on a lot of the BLS stuff, especially as it relates to job losses and things like that. There's so much noise. I would have been shocked if the PPI numbers were a little hotter than we would have thought, but it just all makes sense. I mean, producer price index. Okay. And what does that measure? That measures basically what it costs producers of any good, right? To buy the materials and produce their good. I mean, look at the tariffs on steel. I don't understand how PPI wouldn't go up.
I don't
It
understand
has
that
to.
either. I
Yeah,
mean,
it
yeah,
has to. Yeah.
absolutely.
So yeah, I mean it's tariffs make things more expensive. So yeah, I look and I really don't have much of a problem. I wish they would have been put on in what would seemingly be a more strategic way.
Yeah.
But I don't think, you and I have talked about this. I'm not one of those people at all that believes that the use of tariffs in the pursuit of a better trade deal is an automatic evil. It's a tool in your policy tool belt. So I just dismiss both of these sides. Tariffs are wonderful, tariffs are horrible. Well, it's all in context, right? So if by putting on these pressures get you a overhauled Chinese deal that lowers our trade deficit with them for, let's say, cuts it by 30 or 40%, then I'm going to look at you and say, hey, on balance, I would say those tariffs were a small price to pay, right? Like they did what they needed to do. Um, if you truly believe that tariffs were how you were going to pay down your national debt, I would say that's not a good idea,
No.
right? So just because you're just passing. I mean, it's just another tax at that. I mean, that's all you're doing. So yeah, I'll tell you what the thought that I thought, or the thing that I thought was the most interesting about the numbers that have come out the last couple days regarding inflation, um, is the PPI data. And if you look at, again, well, PPI data, and you look at it in contrast to a lot of the economic reports. Now, a lot of those economic reports are not hard, meaning they can be tricky and a little bit misleading too. But I'll tell you what it looks like. It looks like stagflation. And that's why I was really shocked about the market's reaction to that inflation data. Um, the headline number that everybody said was good was lower than expectations. It wasn't showing the underlying, that was being basically held down by just consumer goods. It wasn't showing the underlying parts of that calculation that are hockey sticking higher, like PPI. So it it was a very bizarre response from the market because that was not good news. It wasn't apocalyptic, but it was the worst of both scenarios. The way the market responded to that, Chad, I would have thought if you would have just showed me the reaction of bonds, the yields on bonds, the dollar, and the stock market, I'd have been like, okay, well, growth came in hotter than expected, and inflation missed to the downside. That's the way it looked, right? Yields were pulling back. I mean, you were like, oh, we got nirvana. You looked at the underlying, and it was the exact opposite. So I don't know what that reaction was. The other thing I'll say is, again, not panic. It's one data point. We knew costs were going to go up when tariffs hit. And I'm not saying, and when I say that tariffs make things go up, I'm not calling Trump a liar, right? Let's take a lot of the smoke out of it. All I'm saying is that tariffs make things go up. That will be reflected in data. And I think that you're running a risk right now of the impacts of those tariffs hitting the economy at precisely a time when it was softening anyway. We'll see if that happens. But, again, none of this is red alert freak out stuff, but it's enough to grab your attention because stagflation is the nastiest of all economic places to be. And when you've got growth softening and prices accelerating up, that's what that looks like. So
It's
yeah,
an ugly
I'm
situation. It is. Talking to Zach Abraham, Chief Investment Officer, Bulwark Capital. And I think people listening are probably going, okay, I know what inflation is. What the hell's stagflation?
yeah. So if you think about it, an economy is always in one of three different, homeostasis areas, right? So you're either in an inflationary environment where typically economic activity and the cost of goods is going up. We've experienced a lot of that lately. You're in a deflationary environment where the value on a relative basis of currencies is going up while the value of assets denominated in those currencies is going down. So think 08, 09, right? Classic deflationary period. And the reason stagflation is so nasty is that usually these things don't combine. Usually inflation typically is part of growth. And it's healthy when your growth rate is substantially higher than your inflation rate, right? But especially where countries are experiencing currency issues, currency devaluations, things like that, you'll run into these stagflationary environments where, despite the fact that prices are going up, you're not seeing increased economic activity. You're right. So you're not getting any of the benefits with inflation, right? We talk about the inflation of like the 70s, and this last period's been somewhat like this too, the inflation of the 70s. But go look at the 70s. For most of that time, you had really strong labor demand. What too,
Yeah.
right? Because that inflation was about the economy really starting to crank up. As baby boomers came of age and household formation started among that age group in the 80s. So stagflation is where you're getting the higher prices, but you're not getting any of the benefits of the growth that comes with it. So where you'd see inflation, theoretically, inflation and unemployment going up at the same time. Um, and that is a really, really nasty scenario to be in because it puts policymakers in a very tough spot, right? You've got a slowing economy that probably needs easing or relief of some kind, but you can't do that because whatever you do just stokes the inflation even hotter.
Yeah. And that's
And
the worry
so
today, right? Like this number is going to give them pause about whether or not they're going to, take it down at, quarter or half point, the Fed.
yeah, and this is my whole point too, and I think that's why it helps to look at these things, regardless of who you support politically. I think that's why it helps to look at these things through a non-political lens, right? Because, like I said, I have to, right? I've got my political beliefs and the things that I think, but then I've got to manage people's money and make money, so we got to get it right. But this isn't us saying that tariffs are good, tariffs bad. This is just looking at the economic data. If you want to look at the economic data as it relates to rate cuts, right now the market's pricing in a 23 basis point cut, which is basically the market saying we're 100% sure or we're 93% sure that you're going to get a 25 basis point cut. That would be the odds on favorite. That being said, if all you did was show me that data, I wouldn't cut if I was in their scenarios or if I was in their chair. And the simple reason why is when you're running, when you've got PPI and you've got several factors of inflation that are reaccelerating and are over your target, right? We're currently at 3.2, something like that. And you've got unemployment at 4.2. There's just nothing about that says to cut. It just doesn't. Do I think that a 25 basis point cut would be a disaster? No. I mean, what's the real impact of 25 basis points? Not a lot, right? But does that data warrant cutting? No.
No.
No, it just doesn't. Now, 30 days from now, data could roll in that completely counteracts that or contradicts that. And maybe you do have a case. Maybe you do have a really deflationary, wind blowing through the economy, but you just don't see it right now.
Talking to Zach Abraham, Chief Investment Officer, Bulwark Capital. You talk about 30 days from now. We're at that time. We're getting, heading into fall. This is it. I mean, for big businesses, everybody, this is their making hay kind of thing. Kind of like the movie Jaws. This is their chance to make money. Otherwise, they're going to go hungry for the rest of the winter because you got the Christmas and Halloween, Thanksgiving, all of these big things. And it's weird. There's a quiet confidence in some ways, I think, in the economy. And there's also a lot of people that are nervous.
Yeah. I think the nervousness comes from, look, it really feels in so many different ways, and numbers look like this too, that you're kind of reaching a maximization point, right? We've been living on a credit card for a while, and you just, the inflation numbers creeping up, and you're just like, guys, it kind of feels like some checks are coming due. You know what I
Yes.
mean?
They're not going to
Um,
raise our limit anymore.
no, and that really, if we're correct about that, that could create some serious issues in U.S. asset prices, U.S. equity markets. And here's the troubling thing about that. We look, this isn't even financial theory, Chad. This is just what it is. Meaning, this economy is more sensitive to stock market gyrations than at any other time in history, and without a question in my mind. Okay, and number one reason why is the second largest generation in history outside of millennials are baby boomers. And you're getting them retiring to the tune of somewhere like 10 to 13,000 of them are retiring a day. Okay. And the baby boomers own, I mean, what is it, 70% of the nation's wealth or something like that? Okay. And remember, every time they retire, what are they relying on? They're not living on pensions,
Yeah.
right? They're relying on their stock market investments. Okay. So when the richest and biggest spending generation in the country, if all of a sudden they hit a 20 to 30% hit to that portfolio and it doesn't just bounce back like it's been, that's going to have a negative impact on the economy,
Oh, yeah.
right? And we used to have stock market drops because of recessions. I think it's very likely now you could have a recession due to a stock market drop. So, because you're just so financialized, and people go, "Oh, that Zach, you're making too much of it," and I go, "Guys, just stop, think about this. If by the time December 25th rolls around and Grandpa Allen and Grandma Janet's, investment accounts down 25% from where it started the year, are they going to buy the kids more or less Christmas presents?
Absolutely.
Of course they're going to cut back,
Yeah.
right? So, and um, having said all that, though, you still have the underlying look. The consumer, financially speaking, is still very well cashed up. You've got record amounts of equity in homes. Um, so I think that there's a lot of things to be concerned about. I don't think there's anything to be panicked about. But I'm going to keep banging on this drum until people are tired of hearing it, and I'll probably bang on it some more. But I do look around the world, and I just cannot feel strongly enough that people need to be we need to really broaden our definition of diversification over what it's been for the last 15 years. You've got to get exposure to, inflationary type assets, precious metals. You've got to get more commodities exposure than is in the present portfolio. And I think you need more international exposure. And when I tell people that, I don't mean go out and just load up on all that stuff, but we just know by looking at the average composition of the average investor portfolio, they've never been lighter on those things. And we're going into a period of time where that's exactly what you need, right? Like and those things are already working.
Yeah.
Um, so I just US, especially when you consider there are many places around the world that have in the interim better looking or easier roads to hoe economically that are trading at significant discounts to US markets. And um yeah, it's both managing risks doing that, but also taking advantage of opportunities because there's a lot of great stuff, especially when you start looking abroad.
Talking to Zach Abraham, Chief Investment Officer, Bulwark Capital. People want to reach out to you. They want to get that second opinion. Want to talk to you about what's it like to trade somewhere else. What do they do?
Yeah, no, so just go to bulwarkcapitalmanagement.com. You can also go to Know Your Risk podcast. We put that out every single day, do about 25 to 40-minute show every day, summarizing everything that's gone on economically and financially. And then we do a longer show every Friday and kind of recap the week and talk about the week's biggest stories. But yeah, not hard to find, Know Your Risk podcast, and bulwarkcapitalmanagement.com.
Right on, brother. Good talking to you. We'll do it again next week.
All right. Thanks for having me, Chad. Fun as always.
Investment advisory services offered through Trek Financial LLC, an SEC-registered investment advisor. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. Any references to performance of securities are thought to be materially accurate, and actual performance may differ. Investments involve risk and are not guaranteed. Past performance doesn't guarantee future results. Trek 24308.